What's up everybody, Tom here with another video. Wall Street bears have just flash crashed the stock market in what can be considered a potential hit and run. In this video, we'll be talking about our technical analysis levels for the SP500, NASDAQ and Volatility Index, and we'll be going through together making sense of what just happened in the market and how we can potentially position in the future to deal with these situations and to deal with what's currently going on. This one should be good. Stay tuned. So first up, what are we seeing? We are seeing a sea of red, people. It is absolute carnage on the market, but we have to put things in perspective. Of course, we expect certain things to fall quickly as they rise quickly. And of course, the number one targets have been the technology sectors last night. Microsoft, Apple, Google, Facebook, and Amazon were all down very hard. And in fact, any of the stocks that have been moving up heavily over the last couple of months were moving down. When you look at things like the old banks like JP Morgan, they of course did not move as much because they're considered the value stocks, and other sectors did not move as heavily. This was purely a hit and run by Wall Street, and we'll talk about that throughout this video, along with our technical analysis levels for several markets right now. But I think putting in perspective is the key. If we go to 1 week performance on a heat map like this, you'll see, yes, Microsoft and Apple are down now, but overall, a lot of companies are still up. This is a flash crash, but it is a flash crash. It does not mean that it's the beginning of a larger crash yet. We are not seeing necessarily the biggest sign. We potentially are just seeing Wall Street stealing money the way they like to do so. So what have Wall Street actually done? Well, I think the easiest way to think about it is that day traders have been in options. Retail traders like you and me have been trading options, specifically short-dated options on popular tech stocks. Now, why do we do this? Well, it's a way of getting leverage into the market, and you can potentially buy a 1 or 2 week bought call and then of course profit off that and get leverage and therefore get more money. Now, if Wall Street create a flash crash like this, what happens? A lot of those buy call strikes expire worthless and you lose your money. If you're not sure how to trade options or what options are, it is imperative that you understand this kind of concept. And I'll be going over that more on this channel over the next coming weeks. So make sure to subscribe and of course hit that alert button. Now, one thing you want to do with options is you want to understand usually the main options expiration calendar dates. We did not have one this week. We are in non-farms tonight, which we'll be doing the live stream of. But realistically, options are expiring every week nowadays, so it is important to note that. So let's go over the base case of what's happening in the market. So I mentioned earlier this week that we're in September. September is historically the weakest month in the S&P 500, NASDAQ, overall in the stock markets. It always has been, and this data goes back from 1928 to now. So you can see that September really is the weakest month of the year. And there's several reasons for this. It's after earnings, it's after dividends, it's after all of those types of things. And it's also just a rebalancing kind of sector as well. Usually August, September and October are those weak months that sometimes start a little bit of selling or dip buying opportunities. The other one though that I want to mention is that we are seeing a correlation, and this is an early warning sign almost every time, between the VIX going up at the same time that the stock market is going up. So if we have a look at this chart here, we can see here the S&P 500 VIX correlation over time. Now, if you don't understand this, the VIX or volatility index should usually be negatively correlated to the S&P 500, as we should see the VIX go down if the stock market goes up, or the VIX go up if the stock market's going down. The VIX is calculated on the 30-day options volatility. And in this case, what we're seeing is we saw volatility increase in the options due to the amount of bought calls coming into the market and the euphoria in the market at the same time as the stock market made all-time highs. And it's usually a warning signal that we will get some kind of flash crash or dip buying opportunity. We mentioned that this week quite a few times. So that's probably, I think, the base case for what's just going on. But I also want to put in perspective what happens when the tech bust happens like this, when we get a flash crash. Well, historically, the next day has usually been positive. Now, generally, when you see something like a 2 or 1 to 2% fall, you usually have 2 to 3 days of selling pressure coming off that. We may see selling pressure because we're going into non-farm payrolls tonight, but historically you usually see a small buy up the next day and then some kind of volatility subsiding, potentially some further declines as it makes a new low, and maybe like that kind of 5-day selling period followed by stronger growth. We've mentioned now we've made new highs. The stock market will usually grow over a 12-month period by about 9%. And if we look at something like the S&P 500, we're almost back to where the previous high was. So there will be still, I'm relatively optimistic on the market longer term. That does not mean we're in for short-term pain though, as the volatility spiking the way it has against the market usually means for a bit more of a dip buying experience. Now here we've got the S&P 500 at the top, and we can see the VIX has of course increased now, but you will notice the VIX started increasing as we made all-time highs and as those buy calls or bought calls became very, very popular in the markets. So let's take a look at some other indicators and see what they're showing us. Well, copper is clearly a very great indicator of economic health or weakness. We are seeing a decent kind of shooting star close here. Some people call it a pin bar. If it did close this way, that would be a negative sign towards the economy. We're underneath now the 3.0 very key level for copper, but we're still at the horizontal support at this stage. So we're at what previously was resistance acting as support. So everything can change tonight during non-farm payrolls. Definitely pay attention to that. And if you're watching this video after the case, always understand key news events. When key news events are coming out, we need to pay attention, and non-farm payrolls is one of those. So we're back here on copper, and if we break through down here, we could be going all the way back to 2.8, which usually signals further weakness in the market. Copper is heavily correlated to the US market, to economic health in general. So it's one to watch and always have on your charts. When we look at something like the dollar index, that's another one. US dollar, if we're seeing strength coming back into the US dollar like we did this week, that can also be an early signal that things are not that right in the markets as people move into the dollar. But I think with the US dollar, we're still stuck in a range. Here we are on a 4-hour chart. We'll go to a daily quickly, and I'll just pinpoint this purple zone that I've drawn up here around the 93.80, 94. Now that may seem like it's a little while away, but we need to break past the previous highs here of 93.35, and then straight in front of that, we've got that 93.80 zone. Now, if we did see the market, the US dollar kind of pick up, go into this, find some resistance, come down, and then break through, this would be the signal that the US dollar strength is back in town. And this is the big signal on the larger time frames that Wall Street and other big hedge fund traders and everybody else is looking at. We're at monthly support that we've talked about at the 92. It's a very strong level for the dollar index, but we would need to see the dollar index play this kind of game here for us to say, okay, we're now signaling further buying opportunity back up into these previous support levels of 96, 95 zones. So for now, the dollar index is stronger than it was, but it hasn't shown us enough strength just yet to give us full technical confirmation that the market's turning around. All right, well, let's talk about this S&P 500. What is going on here? Is the S&P 500 a buy now or a sell now? I'm not going to give you necessarily the full answer here because, of course, you have to make your own decisions. But here's one of the things that you can always put on a chart, and that is central monthly pivots or central pivots in general. When we have pivots in the market, the S&P 500 will respect monthly pivots. Why is this? Well, pivots are definitely heavily used in the market and they make a lot of technical sense. So we've just seen basically the central pivot for this month, the 34.32, be tapped on the S&P 500, and it's found some support there already in terms of buying pressure. This level can be hit and can find support. We found support during the last flash crash in June as well, where the central pivot was hit, and then we saw buying pressure coming off that. Central pivot hit in May, buying pressure off that. So could we see this as a first area where people are purchasing? It definitely could be, and it's certainly around those previous highs as well. So central pivots certainly are a point, and then of course S1s and S2s are also points of buying pressure that will come in through the markets. When we look at something like the US 100, well, I mean, there was a 1 hour kind of double top up here that signaled kind of the close sell down. I think the biggest thing though for me is the moving averages. We saw an aggressive trend touching this 50 exponential moving average. It was doing it every single time on the way up. Now notice this was the first time it was unable to make a new high, and then we got to close through this zone And once we made that new low here, it was a flash crash. Effectively, we saw a flash amount of selling, and that was really the pressure there. Now, every situation is different. This is a 1 hour chart on the NASDAQ, but it just shows you that when you recognize a pattern such as this 50 moving average, exponential by the way, holding the market up every dip buying opportunity, when that breaks, it becomes an incredibly important zone for us to be paying attention to, and it certainly was here. Now, where can the NASDAQ go next? Well, the NASDAQ's just hit the daily 20 exponential moving average. Now, let's have a look at trends. What has happened during this trend up? 1 buying opportunity, 2 buying opportunities, 3 buying opportunities, 4, 5, 6, 7, the list goes on. What did we just see on the NASDAQ on the 1 hour? It broke past the 50 on the smaller time frame, and then after that point, it sold off. So here we've hit the 20. Now, we would expect buying pressure to come in here, and we are seeing a little bit of buying pressure coming in the futures as we shoot this video. However, if it gets through this zone, where's it going to go next? Well, it's most likely going to go to the 50 exponential moving average, another heavily used moving average, where it will form previous resistance because of the nature of where that market was. So that was around that 11,000 psychological level. So we may see the market get through the 20 this time. Obviously, this is the general trend of the buying. The only problem this time is we went so far away from the 20. Will this just be a flash crash and then pull up, or will this be the next point where it comes back down and it hits that 11,000 support? There'll be a lot of buying pressure, I would say, at this level as well. Let's take a look at the S&P 500. Well, the S&P 500, very similar to the NASDAQ. It has hit its 20 moving average. That has been buying pressure multiple times during this run up. So in terms of dips, we have dipped into the general buy zone in terms of where we are right now. Now, if we go to a weekly on the S&P 500, I've mentioned how we are still very, very far away from the 20 exponential moving average here. Now, that will creep up because it's based on the last 20 candles, but at this stage, we're still very far away. We've moved a little bit too fast, too quick. So depending on non-farms tonight, we will get a very good gist of what is going to happen next week. If you're necessarily not in the market, potentially you wait and you look at what happens during the non-farm payroll release. Then you make your decisions when trends start next week, and then based on the lack of news during that kind of period. So the S&P 500 still very, very far away. It's hit its first level of support. We've obviously got multiple support levels underneath this. Price action support at the 34, 33.92 level, where previous resistance will act as support. And then we have that 3,200 massive support where previous resistance also intersects with the weekly 20 exponential moving average. So hopefully this video helps everybody today. If it did, remember to subscribe and of course hit that alert button. We're doing live stream tonight and live stream next week during the opening bell. So definitely check those out. And we appreciate, as always, everyone following this channel. Just a quick reminder, we are giving away $500 to just being a subscriber of this channel and possibly following us on one of the social medias down below. And we're doing that when we hit 20,000 subs. We're so close now, and I just want to thank every single one of you out there for being a subscriber and, of course, supporting the channel. Thank you so much. Have a great weekend. If I don't see you tonight, I'll see you next week. Bye for now.